I'm here with Sam Moore, Executive Director at Capital Prudential. Sam, welcome to the Inside Network's Income and Defensive Asset Symposium.
Thanks for having me.
For advisors that are new to the name of Capital Prudential, could you give a quick summary of your story and the spaces you operate in?
Sure. So 3 founders in the business back in 2019. So COVID the following year. So that was an interesting time to get the business up and running.
I bet.
We now have staff involved in the business in terms of being shareholders and a few strategic ones as well. But the founders still own about 70% of the business. Backgrounds of the founders: banker, lawyer, property developer. And what we saw was an opportunity in the market to provide our investors with access to the attractive returns from property development, but delivered entirely as regular, predictable income. Historically, when people have invested in property development, there's been a single property development that they've invested in under like a property syndicate type structure. So that'll have a targeted return. It'll have a targeted time frame for completion of the development, which is the term of the investment. And it'll be a single exposure to a particular property development. So that'll mean one builder, one location, one development type, so whether it's commercial or residential. And importantly, it'll be 1 point in the property cycle and 1 point out in the property cycle. And the returns to the investor are delivered entirely as capital return. So what we wanted to do is turn that on its head, especially with the ageing investor market in Australia and those looking for income. And so we've come up with a way to structure our fund in order to deliver that. The other thing that we wanted to do was in the small to mid-scale development space. You find development managers that are extremely good sourcing and delivering developments, but they do it on a development by development basis. So once they've gone out and found a development, they've de-risked it, they've got it ready to commence, then they have to turn around and find the capital. We wanted to provide them with eligibility criteria or some tram tracks within which they knew our fund was looking for developments. And so when they go out and look for developments, they know with a reasonable level of confidence, if they find the developments that we're looking for, we'll fund them. So that's sort of a bit of secret sauce, if you like, because it allows them just to focus on what they are great at doing.
Okay. And within that, what does the risk mitigation look like?
So we have obviously a lot of risk mitigation in place, being property development. And some say there's not necessarily higher risks involved in property development. There's just a lot of them. So you need to manage them well. One of the things we do, I talked about eligibility criteria or tram tracks. So for example, when we're doing our resi property developments, we don't do any high-rise or urban sprawl type developments. Now they're good developments, they just don't suit our fund. And when we're doing commercial developments, we're really looking for specialty commercial. So fast food, service station, childcare, developments, commercial developments where we can find good long-term tenants in advance for those types of properties when they're completed. The other thing we do is for example, cash control. So that the risk management framework we have in place means that we control all of the cash. So we're doing all of the cash control for the developments. We're regularly reporting to our board monthly. So the fund board gets a monthly development management report, which includes reforecasting on each development. And the other thing we've got, of course, is skin in the game as the fund manager.
And what role do you see it playing in a broader portfolio of assets? What sleeve does it specifically fit into?
It's a good question because advisors have different views on that. We'd say alternative fixed income. I mean, you're getting equity-like returns delivered with a great degree of certainty. And you're not exposed to bond yields or credit spreads, the movements across the public markets. So the investors are seeing those expected returns are generally the actual returns that they're getting.
Okay. And Sam, what do you think could be the biggest surprise for markets as we move into the back half of 2024?
Well, I did float this answer with my sales guy. Robotaxis. That's what I was going to say.
Robotaxis.
I don't know if you follow Elon Musk, but he said on the 8th of the 8th, they were going to announce robotaxis were coming out, and then it's in October. But robotaxis are my thing. I'm very interested to see what happens when we got autonomous vehicles into the market. Apparently, the cost of a trip will be 10% of the cost of a trip today. So that'll completely disrupt the auto market.
I do recall that was his most bullish statement on the most recent investor call, Tesla. Brilliant. Sam Moore, thanks for joining us.
Thanks very much.